Hello friends, welcome to Finavision, your one-stop solution for CFA classes. My name is Shushmit Aditya Mukherjee and this video is part of the full chapter videos taken as part of the CFA Level 1 curriculum. If you want to access more such videos, the playlist is given in the description, so please check that out. Keep watching and let's get started with this class. So friends, today we are going to start another chapter in CFA Level 1 which is long-lived assets, and this is part of the financial statements analysis. So let's say there is a company called OpenAI. There is a company called OpenAI which is making this new chatbot called ChatGPT. We have all heard about it, right? So OpenAI requires certain things. OpenAI requires certain things. What are they? Number one, it requires qualified engineers. Qualified engineers. Now, these engineers, what they will do? They will design specialized algorithms. They will design specialized algorithms which in turn will create this highly intelligent chatbot. Highly intelligent chatbot, which is called ChatGPT, right? And this is supposed to be so intelligent that people stop using search engines, right? So that people stop using or stop needing to use search engines, right? So this has to be so intelligent. So for that, these algorithms have to be highly sophisticated, right? These have to be highly sophisticated. So these algorithms, which form part of something called generative AI or Gen AI, these are actually what? For OpenAI, these are actually what, friends? These are intangible assets, right? Intangible assets. These intangible assets, they can create patents out of them. They can create licenses out of them, right? These licenses they can rent out to other companies which they can use, right? The entire algorithm obviously they will not reveal, but certain parts they can create licenses out of it which other companies can use and create their own overlays over the chat GPT or the chatbots or the algorithms, right? So OpenAI, we have said, requires qualified engineers who create what we call intangible assets, right? Then for all this to happen, they require a lot of hardware. Let's say the most sophisticated hardware provider for OpenAI is NVIDIA. Let's say NVIDIA creates processors, memory spaces, and their interconnective networks. NVIDIA provides hardware technology that creates exponential reduction in spaces, exponential reduction in space that is required, exponential reduction in energy that is required, and exponential decrease in cost that is required, right? These three things NVIDIA provides. And this helps OpenAI build data centers which are much more cost efficient, energy efficient, and space efficient, right? So they are going to build data centers. So these data centers are like factories from where these AI solutions are created. These AI solutions like ChatGPT are being created from these data centers. So these data centers are like factories, right? Now, now let's say to hire these engineers and buy these data centers and build these highly valuable intangible assets, OpenAI requires capital. OpenAI requires capital. And for arranging for this capital, OpenAI issues equity. It issues equity. And it is a private equity. And this equity, Microsoft invests in this equity. Right, friends? Now, what is happening here, friends? OpenAI takes investment from Microsoft, hires engineers, builds data centers, and creates these highly sophisticated AI solutions. Now, friends, why are we taking this example? Through this example, what we are trying to do is understand what is the meaning of long-lived assets. So, friends, what are long-lived assets in our given example? Let's understand. There are basically three primary ways, types of long lived assets. One is property, plant, and equipment. Second is intangible assets. Third is financial assets. Third is financial assets. So property, plant and equipment, intangible assets, financial assets. Now, in our example, all these three types of long-lived assets are there. Where are they? Firstly, intangible assets, we have already spoken about it. The patents, the licenses, these are intangible assets. Right, friends? They do not occupy space. They are not visible, but they are assets in a way that they help the company earn income. They help the company earn income, right? Earn income or earn profits. So these are intangible assets. ChatGPT has a subscription model, so it is an intangible assets. Now ChatGPT is not a building, right? It is not a building which you can touch, but ChatGPT is there and it is helping OpenAI earn profits or earn income. So ChatGPT is kind of an intangible assets. Sora is an intangible asset. Dali is an intangible asset. You can say these are actually products in that way. But these are intangible products. You cannot touch and feel them, but they are products which are earning profits for OpenAI. Now, we have understood what is the intangible asset part in our example. Now, what are property, plant and equipment? Property, plant and equipment in our example are the data centers. Data centers. These are spaces which are behaving like factories or manufacturing units which are creating or popping out these highly sophisticated artificial intelligence solutions, right? So they are acting like the property, plant and equipment. For an automobile company, obviously it is very obvious. It can be a manufacturing unit of the automobiles. For a spacecraft company, it can be the manufacturing unit of the spacecrafts, right? For a mining company, it can be the mines, it can be the equipments through which the mining is being done, right? So these, in our example, the data center is the property, plant and equipment. Now, coming to the financial assets. Where are the financial assets in this example? Already, friends, we have said that OpenAI issued equity in which Microsoft invested. Right, friends? So for Microsoft, this equity of OpenAI is a financial asset. This is for Microsoft. For Microsoft, the equity of OpenAI becomes a financial asset. So any equity or debt which it owns of some other company is a financial asset for this company. So say company A has given debt to company B. Company A has given debt to company B. Then this debt is a financial asset for company A. This debt is a financial asset for company A. Or it has invested in the equity of company B. Then also this equity of company B is a financial asset in the balance sheet of company A. Likewise, Microsoft will show equity of OpenAI as part of its financial assets. Right, friends? So the three types of long-lived assets are property, plant and equipment, which in our example are the data centers. Intangible assets, which in our example are the patents, licenses and the artificial intelligence solutions themselves. The financial assets for Microsoft is the equity of OpenAI. Now friends, we'll go into more details of how these property, plant and equipment, intangible assets and the financial assets are recorded in the balance sheet, how they are reviewed in the balance sheet periodically and all that. So let's start with that. Acquiring and recording of property, plant and equipment. So we have already spoken about OpenAI and its data center, its engineers and its intangible assets, friends. So we'll continue with that example itself. Let's say OpenAI with the investors' money has two data centers, data center 1 and data center 2. Right, friends? Data center 1 and data center 2. Let us call it D1 and D2. Now, in data center 1, there were existing hardwares of OpenAI already there. There were existing hardware already there. What OpenAI did is to buy the new gear from Nvidia, it exchanged its existing hardware of data center 1 with Nvidia, which Nvidia can do recycling or whatever they want to do. They found it valuable, they have taken it, right? So they had their existing hardware which they gave to Nvidia and exchange it with the new hardware, sophisticated new hardware which is for generative AI, right? Now, how will this exchange be recorded in the balance sheet of OpenAI? How will this be recorded? So how will this be recorded, friends? Let's see. The options for recording exchanged property, plant and equipment go in the following sequence. First, fair value of the new assets, fair value of the new purchased assets, right? So after exchanging the new assets that the company acquires, the fair value of that is recorded. How is it recorded, friends? It is recorded at fair value or at cost. Both mean the same thing. So in case of OpenAI, Nvidia has a particular cost because it is producing something very, very unique. It has a fixed cost for its hardware. So that cost is recorded here. Now suppose it was buying something for which the fair value could not be deciphered. The fair value of the hardware, new hardware, could not be deciphered. Then what would happen? Then the fair value of the exchanged hardware or the old assets, in this case, the exchanged hardware would be used. So if the fair value of the new hardware is not available, then the next step is use the fair value of the old hardware or the old asset, or in this case the existing hardware that was exchanged, right? Now let's say the fair value of this existing hardware also could not be deciphered by OpenAI, right? Its fair value was not properly deciphered. Then we go to the third option, which is the carrying amount of the old hardware or the old assets. The carrying amount of the old assets, in this case, which is the existing hardware, right, friends? This is the carrying amount. So fair value of the new assets, if that is not easily decipherable, then fair value of the old assets that is exchanged. If that is also not found, then carrying amount of the old assets, right, friends? These are the sequential options. If the first is not available, we go to the second. If the second is not available, we go to the third. That's how you do it. This is the case when exchange of assets is happening, right, friends? Now we have a data center 2. This is a newly built data center. There were no existing hardwares here. So OpenAI is simply installing Nvidia hardwares, which are new hardware directly here. So there is no exchange happening. It is a direct purchase. It is a direct purchase. There is no exchange. In this case, friends, the way is, in case of this purchase, the way is record at fair value or at cost. Both are same. And all these values, where you are recording, friends? Obviously, you are recording in the asset section of the balance sheet. This goes without saying that you are recording all this, including all this, in the asset section of the balance sheet. Right, friends? Now, friends, let's say OpenAI bought 1 billion worth of hardware from Nvidia. 1 billion worth of hardware from Nvidia. They estimate that this new hardware, this technology will not become redundant for the next 15 years at least. So friends, this 15 years obviously is greater than 1 year time period, right? So, but along with it, they bought certain other items or certain other accessories. But along with it, to run the data center energy efficiently, to run the data center if energy efficiently, they bought certain other hardware. They bought certain other accessory hardware which would last only 1 year or less. Right, friends? Now, do they treat both of these assets in the same way, friends? This accessory hardware and the new hardware? No, right? The accessory hardware, the accessory hardware has a shelf life of 1 year or less. The new hardware has a shelf life of at least 15 years, that is 15 years or more. So, both have expenses, right? The new hardware costed 1 billion. Let's say the accessory costed 5 million. We already know the new hardware goes to the assets. The reason? The reason here is it has a shelf life of more than 1 year. In this case, 15 years. Right, friends? What happens to this accessory hardware, friends? This accessory hardware, the value, this 5 million value, this is expensed. This is shown in the income statement. This is recorded in the income statement as part of the expenses. Right, friends? You can call it the income statement or the profit and loss statement or whatever, but it goes into that. Because, again, the shelf life of this accessory hardware is less than 1 year. Less than 1 year. Now, friends, to run this $1 billion hardware, the energy requirement is, let's say, 100 million. The energy requirement is 100 million. How are that treated? Obviously, energy requirement is transient. So utility of energy is monthly, bill payment of energy is monthly or something. So this will also be expensed away. This will not be part of the assets. Right? Now let's say, friends, this 1 billion hardware was actually not 1 billion. This was basically $995 million of proper hardware plus certain reinforcements that are required to install this hardware. Now this was worth 5 million again. Now how do you record this? One, friends? This again you record it in the assets. So for installing the main asset, if some accessory asset was purchased, no matter how small that amount is, this has to be recorded in the asset. Right, friends? Another example can be, let's say, to transport this hardware of NVIDIA, to transport the hardware from NVIDIA's headquarters or NVIDIA's plant to OpenAI's data centers, D1 and D2, the expense was 5 million. Now, how is that recorded, friends? That is recorded within the $1 billion. Which is the total cost of the new hardware purchase mentioned here. The total cost of the $1 billion hardware purchase, this will contain all the additional costs necessary for the installation of this asset in the first place. All the additional costs necessary for the installation of this new hardware in the first place. Right, friends? That will also be recorded in the asset segment. So the transport fare, the freight charges, that will also be part of this 1 billion. Right? So the actual hardware might have costed only 995 million and the transport cost added, it becomes 1 billion. Now, friends, a little caveat about the fair value of new assets. We have already said the fair value of the new asset and its cost are mostly the same thing. Why we have said that, friends? Let's say in our example, NVIDIA charges certain amount for this new hardware. In our example, it is $1 billion. Right, friends? This costs $1 billion. Now, fair value is defined as the value that you will need to pay if you have to sell this asset, right now in the market, this new asset right now in the market, if you sell, the price that will mostly get, that is the fair value. Or if you want to replace your current assets with this new asset, the price you have to pay is the fair value. So in both cases, in both these definitions, the price given by Nvidia is a very accurate measure of what the fair value of this new asset can be. So we have said fair value and cost virtually mean the same thing. In most cases, it does. Especially when you are buying from a competitive market in an open and free market, and you are buying in an arm's length distance. That is, you are buying in a free and fair way with no favors to anybody. Right, friends? Borrowings to build long-lived assets. So how they are recorded, friends? To understand this, we have to understand a concept called capitalization. Now, friends, in the last example, we said that $1 billion worth of new hardware was purchased by OpenAI for building its data center infrastructure, right? Now, this has a shelf life of 15 years, right, friends? Now, what do we mean by capitalization? This amount would be capitalized. This amount would be capitalized. Now, what do we mean by capitalization? So, in the balance sheet, at the time of acquisition, that is time t is equal to 0, the amount of asset in the balance sheet for this acquisition will be $1 billion. Now let's say the shelf life is 15 years for this asset. So at t is equal to 1, that is after 1 year, the asset amount will reduce. Reduce by how much, friends? This asset will reduce proportionately over the 15-year period. Okay, friends? So let's say we are reducing it in a straight line or uniform method. So the reduction at t is equal to 1, that is beginning of year 2 and end of year 1, the new recognition amount is 1 billion minus 1/15th of 1 billion. This is equal to 14 by 15th of $1 billion. The approximate value of this is equal to $933.33 million. Right, friends? So at t is equal to 1, this will be the new asset amount of the new hardware that we purchased 1 year back. At t is equal to 2, how much? At t is equal to 2, again, it will be 933.33 minus 1/15th of 1 billion. Because this 1 billion will become 0 over 15 years, we are distributing this asset into 15 years and capitalizing 1/15th of it every year, right? So this will become 933.33 minus 1/15th of 1 billion. This is equal to $866.66 million. Now, if you keep on doing this till t is equal to 15, you will see that the value of the asset has gone to 0. The value of the asset has gone to 0. This slow reduction of the asset over a period of years, multiple years, is called capitalization. This slow reduction of the asset value, which is recorded at t is equal to 0 over a period of its entire shelf life. It can be 10 years, 15 years, 20 years, 100 years. In our case, it is 15 years. We distribute this asset value across the lifetime of the asset and reduce it in a straight line or an exponential way or a quadratic way. That depends. In our example, we have taken the straight line. We'll get into how many types of ways we can reduce this asset, but the main point is we reduce it, and we do not reduce it suddenly. We reduce it step by step over years. How do we record the borrowings related to the long-lived assets? So for the sake of our example, let's say we are building this data center, right? We are building this data center 1 and 2, and we have a building which we have to build, right? To go into the specifics, for telecom and data center infrastructure, the wall height should not be like residential buildings, they have to be much higher, 20 feet, 12 feet, 15 feet, like that. So to build a unique kind of building which can sustain data centers, there is a certain cost and a certain amount of time which is required. So let's say this building requires 3 years to build, and this building will cost, the cost of making this building will be $100 million. $100 million. Now, this $100 million, OpenAI decided that it is not going to fund itself. It is not going to fund itself. It is going to borrow funds from the market. What it does is it borrows 80 million out of this cost. It borrows 80 million out of this cost. Right, friends? Now, do we capitalize this borrowing cost? Do we capitalize it? Or does it become part of our expense? Do we capitalize it or does it become part of our expense? So let's say this $80 million OpenAI has borrowed for 5 years. $80 million OpenAI has borrowed for 5 years. Now it is going to make uniform payments at the beginning of every year. So year 0, it has taken the 80 million fund. Year 1, it is going to make its first payment. Year 2, second payment. 3, third payment. 4, fourth payment. And 5th, the last payment will be at the end of the year 5. Now what will be the amount, friends? 80 million is the principal amount. 5 years is the time. Let's say 8% is the interest rate. 8% is the annual interest rate. So what will be this uniform payment? What will be the value of this uniform payment, friends? It is very easy to find out, friends. Let's say present value is 80, future value is 0, PMT, we have to find out the PMT, IY. I'm just taking the reference of your BA2 plus calculator keys, friends. The IY is basically the yield or the interest. Here it is 8%. Right, friends? IY is 8%. Now, N, which is the number of periods, again I am taking reference of your calculator. This will be 5 payments, 5 yearly payments at 8% over a loan of $80 million. They have to be uniform payments. Because they have to be uniform payments, there is no future value. So the FV is 0. So everything that is going to be paid comes in part of the PMT or the periodic payment. So we can easily calculate this value, friends. Let's calculate it. N is 5. Present value is 80. Future value is 0. Interest is 8%. Therefore, the PMT is equal to 20.036. Now, friends, starting from year 1, 20.036 million has to be paid. So, do we capitalize it or do we expense it? The question is just this. Now, at year 3, the construction of the building is complete. Right? So, the question of capitalization or expending is answered here only. At t is equal to 3, the building is complete. So, till t is equal to 3, the borrowing will be capitalized. This portion will be capitalized. And the remaining portion, t is equal to 4 and t is equal to 5, this will be directly expensed. And this capitalized portion will be expensed post the building is ready, that is after t is equal to 3. Let's say from t is equal to 4, this capitalized interest will be expensed over the shelf life of the building. So let's say the building has a shelf life of 100 years. This expensing will happen across 100 years. This 20.036 into 3, this entire capitalized interest portion or capitalized loan payment portion will be expensed across 100 years. Now, friends, we move to the next section. Intangible assets. So, friends, intangible assets a company can own in multiple ways, specifically 3 different ways. Let's take our example forward. In case of OpenAI, ChatGPT, let's say, has been developed internally. So this is an internally developed intangible asset. Now let's say OpenAI acquires a company ABC to enhance its LIMs, large image models. Large image models. So ChatGPT was a large language model development, LLM development. Now OpenAI also wants to do excellent work in the spaces of images and videos. So it takes over a company ABC which has certain insights into large image models. Now this company ABC has certain intangible assets, right? Now, after this acquisition, these intangible assets form part of the OpenAI balance sheet. So, these ABC intangible assets are intangible assets which are acquired through business combinations. So, internally developed and business combination. These two are ways in which a company acquires or creates intangible assets. Now, a third way can be, let's say, OpenAI buys a patent from a company PQR. PQR is an algo trading company, and OpenAI is looking to create a specialized GPT or a specialized artificial intelligence solution which will provide stock market related solutions. Now, they have not acquired PQR, but they have just taken one patent to innovate in the field of stock markets. So this becomes an acquisition other than business combination. So we discuss here three modes of intangible asset acquisition. The first is developing something internally. The second is acquiring through combination of business. The third is acquiring through other means than business combination, right? Like buying a patent or buying a license subscription, etc., etc. So these are the three major ways of developing or creating intangible assets. Technology companies like OpenAI's, or for that matter any other company, can go through many phases. For example, let's say OpenAI built ChatGPT. But prior to finalizing this product, OpenAI must have had phases where it had nothing to show, right? But a lot of development cost or research and development cost was being incurred, right? There was nothing to show. They did not know what is the future outcome, but they have had a direction, they had a vision, and they were putting resources into the research and development. Now, what to do with this research and development cost when you do not have anything to show for it? No tangible development, no product, or no possibility of product even. How do you treat that R&D phase or the expenses in that phase? That phase prior to development, whatever the research expenses are there, that has to be expensed. So let me not call it R&D, let me only call it R, or research. The research expenses prior to development have to be expensed. This is according to IFRS. Now, let's say there was a phase where they were having some glimpses. There is a solution. That is, there is a product in the horizon. We do not actually know what that product can be exactly, but we can definitely say that we can build a product, right? So this is, you can say, the first eureka moment, that they know that some product is in the horizon, it is visible. They do not know exactly what is the shape and form of it, how to price it and all that, but they have a product, they have a solution. From this point onwards, the expenses are called development expenses, right? The initial research where there was not any exact direction, but research expenses were being incurred, that is taken as expenses. But after some direction is achieved, after they can see that, okay, there is some product coming to shape, but we do not know exactly what that is, that phase is called the development part. These expenses can be converted into intangible assets. Now, friends, all this is according to IFRS. Now, IFRS does not distinguish between softwares which are going to be used for internal purposes and those softwares which are going to be sold, right? Now, what if there is another layer of bifurcation where post-development, the accounting system wants to understand whether that software is for internal purpose or for selling purpose. Now, ChatGPT obviously is something which is used for earning income, which is for sale, right? It can be subscription, it can be licensing, whatever, but it is for sale. Essentially, it is not only for internal use. So, at this level, USGAAP creates another layer of differentiation. If it is only for internal use, then the costs have to be capitalized. This is as per USGAAP. This differentiation is only respect to the software which is going to be used only internally, that is only for internal use purpose. And what about the research and development expenses, friends? Here also, US GAAP recommends that the research and development, the expenses related to both these phases are expensed away. They should not be capitalized, or there should not be any asset creation. They should be expensed away. So to sum it up, IFRS allows development phase expenses to be included in intangible assets, research phase expenses to be expensed away. On the other hand, US GAAP wants both research and development expenses to be expensed, and those softwares which are only for internal use, that expense after the software has been created be capitalized. So this is under US GAAP. All this said and done, what can be defined as an intangible asset? Under US GAAP and under IFRS, there are certain criteria which are used to define an intangible asset. Let's say for IFRS, there are 3 criteria. Number 1 is the asset should be identifiable. That is, it must have some contractual or legal identity, or it can be separated from the entity. Number 2, the asset must be controlled by the company. The asset must be controlled by the company who is claiming the intangible asset. Number 3, they are expected to give future income. Now, if OpenAI has patented the technology they have developed, if they have patented the Gen AI technology, then they fit into all these 3 criteria. Now, what are the criteria under US GAAP? There are basically 2 sub-criteria. One is it must have a separate legal identity or contractual identity. Legal or contractual. Or it has to be separable from the rest of the firm. Clearly separable from the rest of the firm. So these are the 2 criteria, either or, under US GAAP. Now friends, we'll move into something called depreciation and methods of depreciation. Depreciation and amortization. So friends, what do we mean by depreciation and amortization? The word depreciation essentially means reduction, right? Reduction or contraction. So what kind of reduction are we talking about? In our ongoing example, we have spoken that OpenAI has bought hardware from NVIDIA, right? It has bought hardware from NVIDIA of value $1 billion, right friends? Now this new hardware from NVIDIA has a shelf life of 15 years, right friends? This hardware has a shelf life of 15 years. Now because this shelf life is greater than 1 year, we have done something with this new purchase. We have not expensed it. We have not recognized it as an expense, right? We have actually spent $1 billion, but this has not been recognized as an expense. What we have done with it? We have capitalized it. We have done something called capitalization with it. We have capitalized it. What do we mean by capitalization? This basically means we have created an asset. We have created an asset of it, and we are supposed to depreciate this asset over its shelf life. So this asset is going to be depreciated over its shelf life, which is 15 years. Why we have done this? Because its shelf life is greater than 1 year. If it was less than 1 year, we would have had to expend it. We would have had to recognize it as an expense. But we have not done that because the shelf life is very long term, 15 years. So we have capitalized it. Now the last thing we said is we are going to depreciate the asset. Depreciate the asset over a period of 15 years. What do we mean by that? It basically means the asset has an initial value of $1 billion. After 15 years, let's say it will have a value of $100 million, right? So over this 15 years, we will stepwise keep on reducing the value of this asset and recognizing those small portions as expenses. So the total reduction in value is $900 million, right? $900 million. And we are going to recognize this over a period of 15 years, right? Let's say we are going to recognize equal amounts in each year, which means every year we'll recognize $60 million reduction in the asset value. And this $60 million will be recognized each year as part of the expenses. Right? So in the income statement, you will find that in the depreciation line, there is a line item called depreciation, which is part of the expenses. There will be an addition of 60 million because of this asset's depreciation. Solely because of this asset's depreciation. Whatever the other expenses are, they will remain the same, plus 60 million, right? So this is going to happen. This process is entirely called depreciation. Now, in terms of depreciation methods, there are various ways we can depreciate the asset. One way is to recognize the initial cost, which is 1 billion in this case, and then reduce it stepwise, like we have done in the previous example, right? Let's say we'll reduce it to 100 million over 15 years. This method of recognizing at cost and then reducing the value stepwise by partly recognizing this initial cost as expense every year slowly, this method is basically called cost model or cost method of recognition of depreciation. This is called cost model. Now friends, in our example, the cost and the fair value are the same, right friends? The cost and the fair value are the same. So there is another method of depreciating the asset, that is recognizing the initial fair value at time 0, that is at the time of purchase, and then at every period 1, period 2, like this, period 3, till the entire shelf life. So period 15, we recognize the fair value once again. So at period 1, we review the entire thing and again devise a fair value, FV1. Year 2, again we calculate the fair value of the asset. So FV2, again FV3 at t is equal to 3, till the time comes when the shelf life is ending, which is FV15, let's say. Right friends? Here the things get much more ambiguous. For example, let's say the value of the asset is found to be 1 billion and our projection is in 15 years there will be some new technologies, so we have a shelf life of 15 years. But let's say at period 10, when we are trying to measure the FV10, we find out that the technology is not going to last for 5 years, instead it is going to last for another 10 years. Now let's say till period 9, the value had been reduced to say $700 million, right? $700 million. Now suddenly we find that instead of 5 years, the valuation or the projection says that it's going to last for 10 years almost. There is a revaluation that has to happen. Now at the 10th year, we see that the proper projection would be to increase the shelf life to another 10 years. Now in this case, the value increases from 700 million, let's say it becomes 800 million, right? It has become 800 million. In this case, how do we handle it, friends? Let's say at FV0, the fair valuation was 1 billion. At FV1, it became 960 million. At FV2, it became 925 million. Like this, the numbers were there. At FV3, let's say it became 900 million. Like this, the value reduced to 700 million at period 9, right? Now, this first reduction, let's say, this first reduction of 40 million, this is recognized as part of depreciation in the income statement, right? This is for period 1. Income statement 1 will have this additional expense. This is due to depreciation, minus 40, right? And in period 2, again, in the income statement, this second level of reduction will be recognized. So this reduction is 35 million. This will be recognized at income statement 2, right? Like this, it will go on. In income statement 3, 925 minus 900, 25 million will be recognized as an additional expense due to depreciation, right? Like this, it will go on. What will happen at period 10, friends? In period 10, the income statement will have an addition of 100 million. An addition of 100 million. Right, friends? This will entirely go into the income statement. Now suppose, let's say instead of 10 years, the shelf life is actually found to be another 20 years. Another 20 years. In period 10, they find that instead of 10 years, the technology can last for another round of 20 years. In that case, the revaluation will be much more than $800 million, friends. It will be, let's say, $1.5 billion. Right? In this case, what will happen to income statement 10? That is the question. The answer to this is all the previous reductions from 1 billion to 960 to 925 to 900, whatever reduction has happened, the entire reduction in value will be first included in expense. So the value at period 9 was 700, right? Now it is $1.5 billion. So the difference of increase is $800 million, right? Now this will be divided into two parts. The first part is recognizing all the previous reductions. And the second part will be whatever is left after that will be added in the equity segment. So first, what about the reductions, friends? The reduction in total is 1 billion minus 700 million. This is equal to 300 million, right? This is the reduction. This will be recognized as a profit. This will be recognized as a profit or gain. Right, friends? This will all be recognized in income statement 10. Income statement 10. That is the income statement for period 10. The rest of the value, what is the rest of the value, friends? The total increment is 1.5 billion minus 700 million. This is the value, 800 million. Out of this 800 million, 300 million goes to the income statement 10. The rest, which is 500 million, this goes to the equity segment, as we said. Right? The asset is increased. Now friends, if the reverse happen, what will be done, friends? So in period 10, the expenses, the gain recognized was 300 million and the equity increase was 500 million. Right, friends? 300 million gain, 300 million plus in gains and 500 million plus addition in the equity segment. Now let's say suddenly in year 14 something drastic happens. In year 14 a new technology is discovered. And the value of the asset has to be reduced once again, because they find that the shelf life will be hardly 2 to 3 years. So the value of the asset has to be reduced to, let's say, 450 million. Now there is a catch, friends. What is the total reduction? Let's say in year 13 the fair value of the asset in year 13 was 1.1 billion. So from 1.5 billion in year 10, here it was 1.5 billion, we all know, friends. In year 10 it was 1.5 billion. This reduced to 1.1 billion in year 13, and then we have to further reduce it to 450 because of a sudden release of a new technology. So the difference, now the reduction that has to happen is 1100 minus 450 is equal to 650 million. Now how is this reduction going to be recognized, friends? Again, there are two steps. First, we have to reduce the equity. Then we have to recognize if anything remains as an expense. Right? As an expense or as a loss. How do we do that, friends? First, let us do the calculations for equity. So the initial value of the asset at t is equal to 0, FV0 was 1 billion, right? FV13, in the 13th year, it was 1.1 billion, right, friends? Therefore, the excess equity due to the revaluation, this is equal to 0.1 billion or 100 million. So this is what is left in equity in year 13, right? In year 14, the total reduction that has to be done is 650 million, right? So out of this, 100 million gets allocated here to the pending equity that is there. So in year 14, FV14 is equal to 1.1 minus 0.1 billion, which is equal to 1 billion once again, which is actually the initial, which is equal to the FV0, right, friends? Now, so 100 million of the reduction goes to the equity segment. What about the rest 550 million? The rest 550 million is recognized as an expense. So expense is equal to 650 minus 100 or 550 million. This much will be recognized in the income statement 14 as an expense or loss. Where does this loss gets recorded, friends? This loss gets recorded in the income statement. as we have said here. And if some equity changes happen like this 100 million, where does this get recorded, friends? This gets recorded in other comprehensive income, and this finds its place in equity segment as revaluation surplus. So when a change in equity happens, it can be increase or decrease. The revaluation surplus changes and the OCI changes, other comprehensive income changes. But when there is a loss or gain, it gets recorded in the income statement. So friends, all these calculations that we have done of recalculating the fair value and then reducing and increasing the values and decreasing the values and all this entire method is the second method. First, we have done the cost model. This is the second model of doing depreciation. This is called the revaluation model. This is method number 2, and this is allowed in IFRS, but it is not allowed. It is not allowed under US GAAP. This is allowed under IFRS, but not allowed under US GAAP. So please remember this. US GAAP requires the cost model to be used only. Now, under the cost model, there are again 3 bifurcations. So under the cost model, there are again 3 bifurcations. Straight line method. So the first is straight line method. The second is double decline method. This is part of an accelerated declining method. And the third is units of production method. So these we'll discuss now. First, we come to the straight line method. Now, from t is equal to 0 to t is equal to 1, that is first year. First year, we note down a few things. We note down the asset value, the depreciation amount, the cumulative depreciation amount, and the net book value. The net book value after the depreciation has been taken care of. So we note these terms. And we note it for each and every year, right? So in the first year, the asset value to begin with is 1000 million. Right, friends? Now, the residual value we already know is 100 million, right? 100 million. Therefore, the total reduction is 900 million. Now, in a straight line method, what we do is we divide this entire amount of reduction. By the number of years, which is 15. So, this value comes to be 60 million. This is our depreciation amount. So, we write it here. 60 million. Right, friends? So, total amount of reduction in value divided by the number of years. This is the straight line depreciation amount. So, let me do one thing. Let me copy this portion somewhere else so that I can use it for the other year calculations, right? So, I've kept the calculation here, friends. If you want to refer to it, this is the initial value minus residual value divided by the number of years, which gives us a straight line amount of depreciation. So, this is 60. This will remain constant for every year, starting from the first year till year 15. Right, friends? Now, the cumulative depreciation amount for the first year is also 60 because there are no prior years here. So, 0 plus 60 is 60. Net book value is 1000 minus 60. That is 940 million. So, at the end of the first year, the value of the asset reduces from 1000 million to 940 million. What happens in the second year, friends? Let's see. In the second year, the initial value itself now is 940 million. The depreciation amount is 60. The cumulative depreciation amount is 120. And the net book value after this year's depreciation amount reduced is 940 minus 60, which is 880 million. 880 million. This becomes the beginning book value of year 3, that is the third year. So what we can do here, friends, is instead of calculating manually here, we can do the same calculation on the Excel sheet. Let's shift to an Excel sheet and do this calculation for the entire 15 years. So here we are, friends, and on the Excel sheet, we are doing the same thing. The initial value is 1000 million, depreciation amount is 60, cumulative depreciation is 0 plus 60, and the net book value is 1000 minus 60, which is 940. Now, year 2, beginning book value is 940, the same book value, minus this year's depreciation, which is again 60, cumulative depreciation, this is equal to the initial cumulative depreciation plus this year's depreciation. This is 120. The net book value after both the depreciation amounts of year 1 and year 2 have been taken into account is equal to 940 minus 60. This is 880. For the third year, the beginning value again is 880. This year's depreciation is 60. Cumulative depreciation is equal to 60 plus 60 plus 60, or 120 plus 60, 180. The net book value is equal to 880 minus this year's depreciation, which is 820. This 820 again becomes the beginning book value of year 4. So this is equal to year 3's ending net book value. This is 820. Depreciation again is 60. Cumulative depreciation is 4 times 60. This is equal to 180 is equal to 180 plus 60. This is 240. So the net book value is equal to 820 minus this year's depreciation, which is 760. So the depreciation amount remains constant for every year. So we can drag the 60 for all the 15 years, right? The cumulative depreciation, this is equal to cumulative plus the current year's depreciation. So we can just draw this downwards also, right friends? This is 900. Now, the beginning asset value for year 5, this is equal to ending book value for year 4, 760. Therefore, the ending book value is 760 minus 60. 760 minus 60. So we can go on this way. Year 6, it is 700 only. Ending book value is equal to 700 minus 60. This is 640. Like this, we can go on, friends, and at the end of year 15, we have the value like this. Let me drag the net book value here first. Now I drag this one, the asset value column also. You can see here the calculations are automatically generated here. At year 15, the final book value is equal to the residual value, which is 100. This is decided by what factor, friends? This is decided because we have decided the depreciation amount to start with, right? The initial depreciation amount was decided to be 60 yearly under straight line method. The reason? Total depreciation amount for the 15 years is 900 and total number of years is 15. So per year depreciation amount is 900 by 60, which is 60 million. So we have our straight line method of depreciation here. Now we can do one more thing. We can do our double declining method and units of production method in the upcoming sections. Now what do we mean by double declining method, friends? In double declining method, what we do is we take the total asset value. We do not recognize the residual value here. We take the total asset value and divide it by 15 years. This value comes to be somewhere around 66.67, right? 66.67 million in our example. Now in case of double declining method, what we do is we double this amount and calculate the percentage. So 66.67 into 2, this is equal to 133.3. This divided by 1000 on the asset value is 13.33% or 13.33%. double declining method says that the depreciation rate per year has to be 13.33% of what? Of the net book value, at the beginning of the period. Right, friends? So how do we calculate it? Let's see. First year asset value is 1000 million. Depreciation amount is 13.33% of the initial asset value to begin with. This is equal to 133.33 approximately. Cumulative depreciation amount is again 0 plus 133.33, which is 133.33 only. Net book value is 1000 minus this amount. So this is 866.67. Now in the second year, the beginning value is 866.67. Depreciation amount is 13.33% of 866.67. So this is equal to 866.67 into 0.1333. 115.53 approximately. Cumulative depreciation amount is 133.33 plus 115.53. 248.86 approximately. Net book value is equal to 866.67 minus 115.53. 751.14. Third year. We can go on doing like this. We'll do one thing, we'll do the same thing in Excel. So friends, we have reached our Excel sheet once again. We have already done the straight line method of depreciation. Now we are moving towards double declining method. So the initial asset value 1000, depreciation amount 133.33. Cumulative depreciation is equal to 133.33 to begin with. Net book value, this is equal to, we calculate it in a different way. This is equal to asset value at the beginning of this period minus the periodic depreciation. This is equal to 866.67. This net book value becomes the beginning value of next year. This is equal to 866.67. Now, depreciation amount is 13.33%, we said, right? This is equal to 866.67 into 0.1333. I will repeat how we calculated the depreciation amount or the depreciation rate once again. In case of double declining method, what we do is we divide the asset value by the number of years. This gives us a value 66.66667 here. Okay, 66.67 approximately. Now, what we do is we double this amount. Double declining, so we double this amount, equal to 66.67 approximately multiplied by 2. We have 133.33. Now, to calculate the depreciation rate to be decided here, we calculate the percentage of this double value with respect to the asset value. This is equal to 133.33 approximately divided by the initial asset value. So this is 0.1333 or 13.33%. 13.33%, right? This is the amount which we are going to use as depreciation rate at all the levels. And how do we incorporate the residual value here? Because we have not taken into account the residual value yet, we will see it afterwards. Now, 866.67 into 1333. This is equal to 15.527111 approximately. cumulative depreciation is equal to initial cumulative plus the current period's depreciation amount. This is 248.86 approximately. So I have reduced all these numbers to 2 decimals, right? Now, net book value at the end of the period is equal to initial book value minus this period's depreciation, 751.14. So this becomes the beginning book value for year 3, 751.14. 13.33% of 751.14 is 100.13. Cumulative depreciation is equal to initial cumulative plus periodic amount of depreciation, 100.30, total amount 348.98. Net book value at the end of the period, initial book value minus periodic depreciation, 651.02. Now friends, we can go on in this way and we can calculate the values. So friends, you can see here we have calculated till year 14. The net book value at the end of the 14th year is 134.94. Initial book value was 115.70. Depreciation amount for the period 13.33% of 155.7, which is equal to 20.75. We have the cumulative depreciation 865.06 and the net book value once again 134.94. Now for the 15th year we have to incorporate the residual value. How do we do that? We have to put in the residual value only as the final net book value. So we are calculating reverse this time. We are calculating reverse. So we are beginning with the final book value and then calculating the depreciation amounts. How we do that? Let's see. Ending value is 100. Beginning value obviously is equal to 134.94. Right friends? Therefore, the depreciation amount would be 17.98. Is it? 17.98 is what? It is 13.33%. So this will not be the depreciation amount for the final year friends. The amount will be 134.94 minus the final book value or the residual value. So this is equal to 34.94. This time we are not incorporating the declining percentage. We are back calculating from the residual value. Now, the cumulative depreciation, this is equal to 865.06 plus 34.94. So which is 900. So cumulative depreciation at the end of 15 years becomes 900 just like before. Only the method we have arrived at is different. So please remember this very vital point friends. Calculate all the depreciation amounts till the penultimate year, that is the year which is before the last year. For the last year, first you write down the residual value, then you back calculate towards the depreciation for the last year. Right friends, this is only for double declining method or accelerated declining method. This is not for straight line method. And then we will see one more kind of depreciation method which is called the units of production depreciation method. How it is to be done? Let us see that. Units of production method. Here what we do is, across the shelf life of the asset, we try to assess what is the number of production units or units of production it can sustain. What is the total productivity it will have year-wise or phase-wise across the shelf life. Let's say we are trying to understand the productivity of ChatGPT over its shelf life. The current model of ChatGPT is ChatGPT 4, let's say. ChatGPT 4. And its shelf life, ChatGPT 4's shelf life is, let's say, 3 years. Right? And the asset allocation, which is out of this 1 billion, the asset which is allocated towards ChatGPT 4 only is, let's say, 50 million. Right, friends? Let's say it is 50 million. Now, in 3 years, let's say its residual value will become 20 million. From 50 million to 20 million in 3 years. Now we have to understand what is the units of production method of depreciation to be taken into account here? Right now, the number of paid subscribers for ChatGPT 4, let's say, is 10 million. In year 2, this is year 1, in year 2, let's say it will become 20 million. In year 3, let's say it will become 50 million before ChatGPT 5 is installed. Right, friends? The cost allocated to building the ChatGPT 4, let's say, is 50 million, and to refurbish it, we will require 30 million. So, let's say the residual value becomes 20 million at the end of 3 years. Now, we will decide how to apply the units of production method from this user-based data, 10 million, 20 million and 50 million. Let's see how to do that. First year, year 1, asset value is 50 million, right? Depreciation amount. This is, how do we calculate this, friends? Depreciation amount, how do we calculate? The way to calculate it is initial value, that is the present value, minus residual value divided by units of production. This is the per unit depreciation under the units of production method. So here this value is present value 50 million, residual value 20 million divided by units of production, which is 10 plus 20 plus 50, 80 million. 80 million. So cost per unit of production is equal to 30 by 80. 30 divided by 80. $0.375. $0.375 per user. Now we have the number of users in each year, 10 million, 20 million and 50 million. So in the first year, the depreciation amount would be 0.375 into 10 million. So this is equal to 3.75 million. Cumulative depreciation amount is equal to 3.75 million only. Net book value. Net book value 50 minus 3.75. 46.25. This is our net book value at the end of year 1. Now, beginning year 2. What is the beginning book value? 46.25. 46.25 million. We are not mentioning the million again and again. We'll keep it 46.25. Depreciation amount. This is equal to 0.375 into number of users for the second year, which is 20 million. So 0.375 into 20 million. 7.5 million. Cumulative depreciation is equal to 7.5 plus initial cumulative depreciation. So 3.75 plus 7.5. 11.25. 11.25. What is the net book value, friends? 46.25 minus the period's depreciation. 38.75. Year 3. Here we do not write the residual value to begin with. We do not back calculate. Rather, we do the calculations in the forward manner only and see if the residual value comes to be 20 million or not. Okay. So, the beginning value is 38.75. 38.75 million. Depreciation amount 50 million users into 0.375. So 0.375 into 50 million. This is 18.75 million. There we have it, friends. Our net book value is 38.75 minus 18.75, which is 20 million. Cumulative depreciation 18.75 plus initial cumulative, which is 11.25. This is equal to 30. So we have our units of production method also deciphered, friends. So friends, herein ends our depreciation section, and now we will go to a section which is called valuation of impairment. Measurement of impairment. Impairment of assets. So what do we mean by impairment of assets, friends? Let's say OpenAI is carrying the same asset still, $1 billion, which it has taken from Nvidia, right? At time t0. So the fair value at 0 is $1 billion. Now years have passed, like 10 years have passed, and after 10 years, the fair value has to be calculated, and it is measured in three different ways. One is sum of all future cash flows. This is one way. Second is present value of the sum of all future cash flows. This is basically the discounted cash flow model. The first one is not discounted. The second one is discounted with DCF. And the third method is fair value if the product is sold. Fair value is if the product is sold. Right, friends? Let's say all the cash flows which are not discounted for the shelf life of this technology sum up to 800 million. The present value sums up to 600 million. And the selling price is 700 million. Minus some selling cost, let's say, which is 10 million. So the net selling price will be 690 million. So these are the prices, these are the values of the asset. The undiscounted fair value through future cash flows, which is 800 million. The same value which is discounted at a certain rate, this comes to be 600 million. And then the selling price less the selling cost. So the fair value when sold minus the selling cost. This is 690 million. Now all these three prices are compared with the carrying amount at period 10. So the carrying amount at period 10, let's say, is 750 million. The carrying amount at period 10, let's say, is 750 million. Now how do we calculate if there is an impairment of asset? Impairment basically means, has the value of the asset eroded more than we think? Eroded more than we think? Which means, should the carrying amount be reduced from where it is written right now? This is the question. So how do we decide here, friends? So IFRS and USGAAP both do the impairment calculation, but both of them do it in different ways. So first we will do what IFRS does. What IFRS does is, it takes the carrying amount at period 10 and compares it with two values. One is the present value of the future cash flows, and second is the fair value when the product is sold minus the cost of selling the product. Now the present value, this is equal to, we can see here, it is 600 million. And the fair value when sold minus cost of selling, this is equal to 690 million, right? And what is the carrying value, friends? What is the carrying amount? This is 750 million, right? So obviously the carrying amount is more than each of these values. So how much do we reduce? Do we reduce to 600 or do we reduce to 690? That is the question. The answer is, we reduce it to higher of the two. We reduce it to higher of the two. So the new carrying amount would be equal to 690, not 750. It will be 690. And a new depreciation schedule will be formed based on this new carrying amount. Right? A new depreciation schedule will be formed based on this new carrying amount. The difference between the previous carrying amount and the new carrying amount is 750 minus 690, right? Which is 60. So 750 minus 690, this is equal to 60. This amount is taken in the income statement as a loss. This is taken in the income statement of period 10. This is under IFRS. Now how would USGAAP do it? USGAAP compares the current carrying amount, which is 750 million. It compares it with only one thing, which is the undiscounted sum total of future cash flows. This is equal to 800 million, right? 800 million. Now, here we can see that the carrying amount is less than the future earnings, right? The carrying amount of 750 is less than the future earnings the asset can have, right? So, US GAAP says that this carrying amount is definitely recoverable. And accordingly, the carrying amount is not changed. The carrying amount is not changed. It remains the same at 750. Now, what would have happened if carrying amount in the period 10 would have been greater than the undiscounted future cash flows of 800 million? What would have happened then? Let us take that case also. Now let's take a second case. In the second case, the future value of the cash flows not discounted are still, let's say, 800 million. The present value is still 600 million. Let's say the selling price becomes 500 million minus selling cost, which is 10 million. So this is equal to 490 million. And also the carrying amount now is 850 million. The carrying amount is 850 million. In this case, how would IFRS and how would USGAAP calculate the impairments? Let's see. Under IFRS, friends, we have already spoken that the carrying amount at period 10 is compared with two things. One is the present value of future income, present value of the future cash flows, and second is the net selling price or the fair value when sold minus the selling cost or cost of sales. The present value of cash flows is 600 million and fair value when sold minus cost of sales, this is equal to 490 million. Now, these two values when compared with carrying amount of 850 million are obviously less. So which one is chosen, friends? As a new carrying amount, which one is chosen? As we have seen before, the higher one is chosen. The higher one is chosen. So in this case, the carrying amount at 10 becomes 600 million. 600 million. Right, friends? Under USGAAP, what happens? Again, first thing that happens is comparison between the existing carrying amount at period 10 with the undiscounted future income or future cash flows are compared. So the carrying amount is 850 and the future cash flows undiscounted, this is equal to 800 million. Right, friends? Now in this case, something else has happened. The carrying amount is more. The carrying amount is more than the future cash flows. So USGAAP says that this asset is not recoverable. So what it does? Now what it does is it checks the fair value when the asset is sold. This is equal to 500 million. Remember, friends, it only takes into account the fair value when sold. It does not take into account the cost of sales. The cost of sales is not considered here. It just takes into account the fair value of the asset when sold. This is 500, right? This is 500. Now, with this value, it replaces the existing carrying amount. So the new carrying amount becomes 500. So the difference is 850 minus 500. This is equal to 350. This is taken in the income statement of period 10 as a loss. This is taken as an income statement loss. Impact of depreciation on ratio calculations. Now, in our example, we said that OpenAI had taken up 1 billion worth of assets, right? 1 billion worth of assets, and it was doing a cost model, let's say. Cost model means it is opting between three methods. One is straight line method, one is double decline method, and the other is units of production method. In all these cases, there will be difference in the impact of ratio calculations. Why, friends? Simply because when 1 billion is being chosen, and let's say the shelf life is 15 years, and we choose a straight line method, the residual value, let's say, is 100 million as before. In this case, the total reduction over 15 years is 900 million, right? The total reduction is 900 million divided by 15 is equal to 60 million every year. 60 million every year. So, from year 1 till year 15, let's say initially the asset was at A0 and the profit in each of these years 1, 2, 3 till 15, without considering the impact of this 60 million depreciation, let's say that is P1 is a profit before taxes, friends. P2, P3 till P15. These are profit before taxes, and they also do not include the 60 million depreciation. Right, friends? Now, what happens when we incorporate this 60 million depreciation? Firstly, in period 1, what happens to the asset and to the profit? Let's see. The asset gets reduced by 60 million. The profit before taxes also gets reduced by 60 million. In the second year, the initial asset value is reduced by 120 million because A0 minus 60 minus 60. So this is A0 minus 120. On the other hand, the second year's profit before tax gets reduced by 60, right? P3, in period 3, profit is reduced by 60. Asset becomes A0 minus 180. Let's say the return on asset without considering the depreciation would have been P1 by A0, P2 by A0, P3 by A0, right? This is without considering the depreciation. But when you consider the depreciation, then return on asset considering the depreciation, this becomes P1 minus 60 by A0 minus 60, P2 minus 60 by A0 minus 120, P3 minus 60 divided by A0 minus 180. This is how it keeps on going. Because of this depreciation, the asset is getting impacted cumulatively, right? The asset is getting impacted cumulatively while the profits are getting impacted periodically, right? So in effect, the return on asset would tend to increase, right? It would tend to increase compared to what it would have been had the asset remained in the same value. So this will have an upward impact on the return on assets, generally speaking. What we can do is we can use a double declining method. A double declining method, we had seen, friends, that will have depreciation in year 1 of depreciation in year 1 is 133.33, depreciation in year 2 is 115.53. Right? We have done this calculation. If you have not watched this portion, you can go back and see in the full class, and if you are watching the short video, the link to this video is given in the description. You can go and check that out. Now, year 1, 133.33, year 2, 115 point something. What was the value? Let me check the Excel sheet itself. 115.53. I'll provide this Excel sheet also. You can access it in Google Sheet form in the links given below. So no worries friends, you can just go through it. Better is you go through the depreciation methods first if you're watching the short video. If you're watching the full class, obviously you have gone through the double declining method before you have come here. So that is not a problem. In case you are watching a short video, do watch this video also, because it will help you understand what we are getting at in a more contextual manner. Now, coming back to this point, the third year depreciation is 100.13. So let us write it. 115.53, 100.13. So like this, you can see the depreciation amount is much more, right? So the profit P1 becomes P1 minus 133.33. The profit P2 becomes P2 minus 115.53. The profit P3 becomes P3 minus 100.13. Like this, profits change. Likewise, the assets also change. A0 minus 133.33. Second one, A0 minus 133.33 plus 115.53. Cumulative depreciation. What is the amount? We can check the Excel sheet. The amount is 248.86. 248.86. Then the third period asset value is equal to A0 minus 348.98. 348.98. So like this, the assets and the profits are getting impacted. Also, what happens is the equity also gets impacted because the asset is getting impacted, right? Equity is basically a function of the asset and the liabilities. So if assets are getting impacted, the equities are also getting impacted, right? What is essentially happening is, if you have a large entry barrier, if you have a large moat on your assets, that is, you do not need to refurbish your assets for technology developments, for improvements, efficiencies and all that. If your asset is already very good and it can last for years on end, then year on year, your return on asset, your return on equity keeps on rising. Year on year, your return on asset and your return on equity keeps on rising, right? So the return on capital, return on asset, return on equity, all these values keep on rising. Provided you are not having to buy new assets or change the assets over very frequently, you are not having to put on huge amount of capex for renewal of assets or expansion on and all that. If you have a set business with a very high entry barrier, then year on year you will see drastic increase in your return on equity, return on asset. This is the impact of depreciation on the values of ratio calculations. Ratio calculations, we have only taken the example of return on asset and return on equity here. But essentially, this can impact everything, starting from return on capital, because that also has an element of equity in it. Then it can also impact things like leverage ratio. Leverage ratios are also getting impacted because leverage ratio is nothing but A by E. A is getting impacted, E is getting impacted. That is, asset is getting impacted, equity is getting impacted. So all in all, leverage is also getting impacted. Like this, you can calculate it on hands, live itself, whatever ratio is given, you just need to incorporate the depreciation and find the calculation. So I think this is it for this chapter, friends. Whatever remaining questions you might have, you may communicate through the comments, or you can enroll to the doubt clearing sessions where we can discuss all these things.
Do you have doubts which you want to get clarified one-on-one? Doubt clearing sessions, mock tests, full curriculum related support, and counseling sessions. We have a bunch of enrollment options at Finavision. Do check out the link in the description and in the comment section below. Thank you so much, friends, for being with me in this video. If this video added value to you, do consider liking and subscribe to the channel. If you think that this video can be of help for someone else, do share it with them and do share your own feedback in the comment section. Till then, keep watching the videos on Finavision YouTube channel. Thank you so much once again.